Hey there! Welcome to another deep dive into the fascinating world of business and finance. Today, we're talking about futures markets. If you've ever wondered how big companies manage risk or how traders make money predicting market moves, this video is for you. Stick around until the end because we'll be sharing some exclusive tips on how futures trading can fit into your financial strategy, even if you're just starting out. So, let's get right into it. What exactly are futures markets? At their core, futures markets are where people buy and sell contracts. But these aren't just any contracts. They're agreements to buy or sell something at a specific price on a specific date in the future. These somethings could be anything: stocks, commodities like oil or gold, or even financial indexes like the S&P 500. Sound intriguing? Let's simplify it further. Imagine this: you agree today to buy 100 bushels of wheat for $500, but you'll actually take delivery of the wheat 3 months from now. That's a futures contract. And the futures market? That's the place where you and the seller shake hands on the deal. Here's what makes futures contracts special: they're standardized. Every contract spells out exactly what's being bought or sold, how much, and when. They're traded on regulated exchanges, like the Chicago Mercantile Exchange or CME. You don't have to pay the full value up front. Instead, you put down a fraction, called a margin. This makes futures trading incredibly leveraged. A small amount of money can control a large investment. And, importantly, they have expiration dates, meaning the deal will be settled by a certain date. Now that we know what futures markets are, let's talk about why they exist and who uses them. Why futures markets matter: futures markets serve a few key purposes, and they're used by a variety of players in the financial world. Here's the breakdown. 1. Hedging against risk. Picture this: an airline needs to buy millions of gallons of fuel each year. If oil prices suddenly skyrocket, their costs go through the roof. To protect themselves, the airline can use futures contracts to lock in today's oil price. This way, no matter what happens to prices in the future, their costs stay predictable. That's called hedging. 2. Speculating for profit. Traders, on the other hand, use futures markets to make money by predicting price changes. If you think the price of gold is going to rise, you buy gold futures today. When the price goes up, you sell them at a profit. But remember, prices can also move against you, leading to losses. 3. Price discovery. Futures markets help figure out what something might cost in the future. This is called price discovery, and it's essential for planning and decision-making in industries like agriculture, energy, and finance. 4. Diversifying investments. Investors often use futures to spread out their risk and add variety to their portfolios. Futures markets offer exposure to assets that don't always move in sync with stocks or bonds. What about S&P 500 futures? Now let's zoom in on one of the most popular futures markets, the S&P 500 futures. These contracts are based on the S&P 500 index, which tracks the performance of 500 of the largest US companies. Here's why they're so important. S&P 500 futures allow investors to bet on or hedge against changes in the stock market. Think the market's going up. Buy futures. Expecting it to drop. Sell them. Even better, they let traders react to market news 24/7, long before the stock market opens or after it closes. The pros and cons of futures markets. Let's talk benefits. Futures markets are highly liquid. They're active and fast-moving, making it easy to buy and sell contracts. Cost-effective. With margin trading, you don't need a lot of cash up front. Flexible. Traders can profit whether prices go up or down. But, and this is a big but, futures come with risks. Leverage risk. Remember that margin. It magnifies both gains and losses. You could lose more than your initial investment. Market risk. Prices can move against you unexpectedly, wiping out your profits. Complexity. Futures aren't the easiest to understand, especially for beginners. Who's trading futures? Futures markets attract a wide range of participants. Hedgers, think farmers, airlines, and oil companies protecting themselves from price swings. Speculators, these are traders looking to profit from price changes. Institutional investors. Big players like mutual funds and pension funds use futures for portfolio diversification. How to get started if you're thinking about dipping your toes into futures trading. Here's where to start. Learn the basics. Understand what futures are and how they work. Choose a broker that offers futures trading. Practice with a demo account. This will help you get comfortable without risking real money. Start small. Don't jump in with huge positions. Build your confidence first. Final thoughts, and there you have it. Futures markets explained in a way that's easy to understand but packed with value. They're powerful tools for managing risk, discovering prices, and even making profits. Whether you're a business owner looking to hedge or a trader chasing opportunities, there's something in futures for everyone. But remember, knowledge and caution are your best friends in this game. What do you think? Have you ever traded futures, or are you considering it? Drop your thoughts and questions in the comments below. Let's keep the conversation going. Don't forget to like this video and subscribe for more deep dives into the world of business and finance. See you next time.